You've probably heard this called the best book on investing ever written. The thing is, it's also over 600 pages long. So we're going to boil down the 5 most critical lessons from Benjamin Graham's masterpiece in the next 5 minutes. Let's dive in. So, let's start with the huge idea at the heart of the book. What if being a successful investor isn't about having a genius-level IQ, but about having the right emotional discipline? This one idea, right here, is the key to everything else. All right, principle 1, and this one is critical. You absolutely have to know which game you are playing. Are you an investor or are you a speculator? Graham argues that most people who think they're investing are actually just speculating. And here's how you tell the difference. Graham's definition of an investment is super specific. See those key phrases? Thorough analysis means you've actually done the homework on the business. Safety of principle just means your number one goal is not losing your money. If what you're doing doesn't meet both of those rules, it's not investing. It's speculation. End of story. Here's the difference in mindset. The investor cares about the actual business, its assets, its earnings, its real value. The speculator? They only care about the stock price. They're just betting on what other people are going to do. They're playing 2 completely different games. Now look, Graham wasn't a saint. He knew people would be tempted to gamble a little, so his advice was simple. Put it in a separate box. Treat it like a trip to Vegas. Use a small amount of money you are totally prepared to lose, and never, ever let it mix with your real investment funds. Okay, so you've decided you're a real investor. Great. Now for principle 2, you have to know what kind of investor you are. And Graham's categories aren't about risk tolerance. They're about how much time and effort you're actually willing to put in. You've got 2 choices. There's the defensive investor, whose main goal is just to avoid huge mistakes with as little effort as possible. Think index funds and chill. Then there's the enterprising investor, who's trying to beat the market by doing deep research and hunting for bargains. But Graham has a serious warning about that second path. And you have to be brutally honest with yourself here. Graham says being an active enterprising investor is a full-time job. If you just dabble in it, you're pretty much guaranteed to do worse than the simple defensive approach. You have to commit one way or the other. Now for what is probably Graham's most famous idea. It's a brilliant little story that gives you a mental framework for dealing with the one thing that wrecks most portfolios: market volatility. So imagine you own a business with a partner. His name is Mr. Market. Every day, he shows up and offers to either buy your shares or sell you his. The only problem, your partner is a total manic depressive. On his good days, he is completely euphoric. He thinks the future is amazing and offers you a price for your shares that is just ridiculously high, way more than the business is actually worth. You can think of this as the market in a bubble. But on his bad days, he is terrified. He's convinced the world is ending and offers to sell you his shares for pennies on the dollar, a price that is pitifully low. And that, of course, is the market during a crash. Here's the whole point of the story. You can just ignore him. His mood is his problem, not yours. An intelligent investor uses Mr. Market's mood swings. You buy from him when he's panicking and selling cheap, and maybe you sell to him when he's euphoric and overpaying. The market is there to serve you, not to tell you what to do. This brings us to the absolute bedrock of value investing. Graham called it the secret of sound investment. It's the margin of safety. It is your ultimate buffer against a future you simply cannot predict. So let's break it down. You do your analysis, and you figure out a business is truly worth $100 per share. That's your best estimate of its real underlying value. But you don't buy it for $100. You don't even buy it for $95. You wait patiently for Mr. Market to have one of his meltdowns, and you buy it when the price drops to, let's say, $60 a share. That $40 gap between value and price, that's everything. That is your margin of safety. It's your cushion for when you're wrong. If your analysis was off and the company is only worth $80, you're still okay. If the company hits a rough patch you didn't see coming, you're protected. It's just smart engineering applied to your money. And that brings us to the 5th and final principle. This is all about the long-term mindset of thinking like a true business owner so you can build wealth that actually lasts. Just remember, holding cash isn't safe. Inflation slowly eats it for lunch. The best defense is owning pieces of great businesses. And when you own a stock, you're not just a ticket holder hoping to get lucky, you're an owner. That means you should demand good management that treats you like one. And this brings us right back to where we started.
Graham's ultimate point is this: success in investing has less to do with how smart you are and way more to do with your character. It's about having the patience and the discipline to stick with a sound plan, especially when Mr. Market is screaming in your ear.
That was The Intelligent Investor in Under 5 Minutes, because I respect your time. If you want to get smarter every single week without reading hundreds of pages, hit subscribe. See you in the next 5-minute summary.